Good morning, everyone. In the interest of time, we're going to get started. So thanks for coming today. If you have any questions throughout the presentation, please use the Q&A function at the bottom of the Zoom, and I'll try and answer your questions at the end of the presentation. But we're here today to talk about the New South Wales and the ACT markets. But what we're going to start with is a bit of a national economic overview, just to give you a lay of the land of how the broader economy is tracking at the moment. So to start with, a good place to start is looking at economic growth and gross domestic product. So if we look over the last 12 months, GDP has only increased by 1.1%. The dotted line you can see there is the long-term average rate of economic growth, which is 3.1%. So the economy is extremely weak in its growth at the moment. In fact, outside of the pandemic, you'd have to go all the way back to March 1992 to see a weaker annual rate of growth in GDP. On a per capita basis, GDP is 1.3% lower over the year, and it's fallen for each of the last 4 quarters. We've never seen that previously. So it really speaks to the fact that the thing that is driving the economy at the moment is the strong rate of population growth, which is lifting overall demand. But at an individual level, we're certainly not feeling as if we're getting wealthier and our economy is growing. So it's a really challenging period at the moment for the economy, and probably one that's being understated somewhat. Some of the other data that comes out of the national accounts is the household saving ratio, and you can see during the pandemic, households were saving a lot of money, and that's because it was very hard to spend. Going in and out of lockdowns, you couldn't travel overseas, and it was hard to spend your money. Plus, there was a lot of government support for people that did lose their jobs. The household saving ratio now is 0.9%. So we're still saving, but very little is being saved. And again, you'd have to go back to before the global financial crisis to see the household saving ratio as low as it is at the moment. And we saw through the mid-2000s that it did turn negative. So it is possible that we see households spending more than they're saving over the next few quarters. On the right, you can see household consumption. So household consumption makes up more than 50% of the economy, and it's been very weak as well. Over the past year, consumption's just been 1.3% compared to a 30-year average of 3.2%. And household consumption is basically just spending. So as the cost of living has gone up, as inflation has been really strong, and as interest rates have risen, households have really cut back on their spending quite substantially. As I just touched on, inflation's been a real challenge for the economy, not just here in Australia, but right across the world. The most recent quarterly inflation data had both headline inflation and underlying inflation at 1%, which was, a bit of a reversal of the decline we had seen in inflation. So that did increase the potential for the Reserve Bank to have to lift interest rates further. Now, that's certainly not our base case, but inflation is still problematic. And while it remains outside of the target range of 2 to 3%, as you can see on there on the right, as it is at the moment, the likelihood of any interest rate cuts is a long way off. I was actually reading some research from Westpac this morning, and they said with all of the energy rebates and some of the things that individual state governments are doing at the moment, they actually think in the next few quarters, inflation is going to fall back into the target range, headline inflation that is. But the problem is going to be once all of those measures are removed, inflation is going to lift back outside of the target range again. So this support that governments are giving to households to try and address cost of living will temporarily slow inflation, but it's not going to fix the underlying problem that we still have. And if we look at what's the source of inflation at the moment, you can see here that goods inflation is growing at a much slower pace than services inflation. The problem with that is a lot of the services that are seeing strong inflation are non-discretionary items. So you've got insurance and financial services. You don't have to pay insurance, but it's best practice to do so. Insurance is going up a lot because the cost of replacing a house or a building has increased significantly. and because, natural disasters are happening on a more regular occurrence. Education costs are up a lot. Education costs are indexed to inflation, so we've had high inflation, so education's been rising rapidly. Plus, you've got huge demand for education services, particularly from overseas students. You've then got housing costs. Material costs are still rising, but the big one at the moment is how much rents are increasing, and that's pushing housing costs higher. Then you've also got alcohol and tobacco. Again, it's the excise is every 6 months, and it's indexed to CPI. So because we've had strong inflation, alcohol and tobacco costs are going up quite significantly as well. So whilst the headline numbers over the next few quarters might start to look quite positive, keep an eye on underlying inflation, because that gives you a better idea of what's actually happening, and that's the figure that the Reserve Bank does tend to focus on. So the cash rate now is 4.35%. That's the highest it's been in 12 years. It's been on hold since November of last year. And looking at the expectations of the market as to when we will get that first interest rate cut, it's now looking at around mid next year. Go back 2 or 3 months ago, and the expectations were that there was going to be an interest rate cut over the second half of this year. September, October was generally the timing. So from September, October to a rate cut mid next year pushes out those expectations quite significantly. And I think for a lot of households that were, really hoping or waiting out for that rate cut later this year, this may cause some challenges for them continuing to, afford essentials, but also to continue to service that mortgage. If I was to have a bet on this, I think that you probably see the cash rate cut March, April next year at the earliest. So the labour market has been a really strong part of the economy over the last couple of years. You can see here that the unemployment rate's 4%. The employment participation rate is 66.8%, which is pretty much a record high. To give you some context, for the last 2.5 years, the unemployment rate's been below 5%. To get it below 5% previously, you'd have to go all the way back to before the global financial crisis. So the labour market is still very tight, but the unemployment rate has lifted from 3.5% up to 4%. If we have a look at the number of employed persons nationally, it's grown by 2.5%. The long-term average is growth of 2.1% over that period of time. And we have seen a deceleration of job creation. The other thing we're seeing is much more growth in part-time jobs over the year than full-time jobs, which indicates some slackening of the labour market. In New South Wales, the unemployment rate's 3.8%, so it's lower than what we've got nationally. And in fact, it's also 3.8% in the ACT. In New South Wales, we've had jobs growth of 2% over the past year, with full-time jobs up 0.2% and part-time jobs up 6.2%. In the ACT, we've seen jobs growth of 1%, with full-time employment up 1.3% and part-time employment rising 0.2%. The ACT is a bit of an outlier whereby full-time employment growth has actually been stronger than part-time employment growth. And if we look at other measures, so the underemployment rate, the underutilisation rate. So underemployment is basically looking at people that aren't getting enough hours. So this could be someone working part-time that wants to be full-time, or it could be someone that's working 20 hours a week. They still want to be part-time, but they'd rather have 30 hours a week. So that's how underemployment is measured. And underutilisation is underemployment plus unemployment. Both are low relative to recent years. Both have started to trend higher, but both remain well below that long-term average level. If we look at in New South Wales, the underemployment rate's 6.5%. The underutilisation rate is 10.1%, so both lower than what we're seeing nationally. And in the ACT, the underemployment rate's 4.6%. The underutilisation rate is 7.9%. Another sign, though, that the labour market is weakening a little bit is the annual change in hours worked. You can see a big slowdown in the number of hours worked, which means that is really reflective of the fact that more of the jobs being created are being created in part-time positions rather than full-time positions. Which then brings us to the number of jobs available. So in May, you can see there was actually a slight uptick in the number of online job advertisements. but they're down 15.5% over the year. And you can see that New South Wales and the ACT have actually seen some of the largest falls over the last 12 months in the number of online job advertisements. Now, there's still a lot of job ads out there on a historic basis, but it is trending lower. And I think this is something we'll continue to see. Businesses will look at, the conditions that they're facing at the moment. The fairly weak business conditions at the moment, weak economic growth. And I think a lot of businesses, as people leave, will go, do we need to replace that role? And some of the open roles, businesses will start to reassess whether they actually need those roles going forward. But the really tight labour market has led to stronger wage increases. So wage growth peaked at 4.2% over the year to December last year. It slowed marginally over the year to March, but we're seeing the strongest wage growth we've seen since 2009. Now, it is expected to have peaked and probably drift a little bit lower from here. But the good news is for the last 2 quarters, annual wage growth has been stronger than annual inflation. So it means that households for the first time in 3 years are actually getting real wage increases. So they feel like they're not falling behind as far as they have been over the past few years. Let's move on to the lending environment. So over the past year, you can see that new lending is up 24.5%. Refinance lending is 16.3% lower. New lending, you can see on the right, rebounding right across the board. Refinancing is down because at the start of last year, that was the peak of people coming off fixed rate mortgages during the pandemic. There was a lot of refinancing at that time. It's slowed down, but also because interest rates have been more stable, there's been fewer people shopping around for a better mortgage deal. If we look on the right-hand side at new lending and the components, so new lending to investors is up 36% over the past year. New lending to first home buyers is up 18.5%, and new lending to subsequent buyers, so this is upgraders and downgraders in the market, is up 18.8%, and it still remains the largest overall segment of lending. In New South Wales, lending to investors is up 44%, lending to first home buyers is up 20%, and subsequent buyer lending is up about 26% over the past year. In the ACT, lending to investors is up 47%. Lending to first home buyers is actually down 1.5% over the year, and subsequent buyer lending in ACT is down 3.8%. So it's really the investor is the only growing market in the ACT at the moment. Which then brings us to the cost of housing construction. So there's 2 components to housing construction costs. There's the inputs, which is all of the materials, and you can see them on the right there. Material costs are up 1.3% over the past year. You can see that there has been a deceleration of growth. The cost isn't falling, it's just growing at a slower pace. Since the beginning of the pandemic, the price of those materials is up about 34%. Then you've got the outputs, which is the civil works, and then the actual construction of a house or other residential property, which is generally a unit. And you can see that we've actually started to see a tick up in annual growth. So house input costs are up 4.3% over the past year. They're up about 44% since the beginning of the pandemic. And output costs for other residential units are up 7%. They're ticking higher, although they're only up about 25% from the start of the pandemic. So what does this mean? These costs generally get passed on to the end user, which is the person that buys those properties. So the gap between a new house and an existing house, there's always usually a premium for a new house. That premium is much wider than it has been previously. So people are preferencing established homes as opposed to new homes. The other place this really plays into the market is people, if they can avoid it, don't want to do major renovations. So there's a strong preference out there in the market for fully renovated properties and less demand for properties that need renovation. Turning to dwelling approvals, they're trending lower over the last 12 months. We've had pretty much the lowest number of dwelling approvals in a decade. Given the population growth at the moment, we definitely need to be building more. And of course, the federal government wants to build 1.2 million new homes over the next 5 financial years, which I think they've got no chance of doing. But if they want any chance, they need to see this trend reverse. Now, that's a lot easier said than done. When you've got interest rates the highest they've been in 12 years, developer and construction finance is higher. it's harder, material costs have gone up a lot as well. So the price of new is significantly higher than existing. So it's harder to get the level of pre-sales you need to go and start construction as well. Labour shortages, all other factors. So it's a really challenging environment to be trying to deliver the volume of housing we're seeking to deliver. In New South Wales, the number of dwelling approvals over the past year was down 11%, and in the ACT, it was down 10% from the previous year. You can also see it playing out in commencements, which are down 6% in New South Wales over the past year, and they're actually up 8% in the ACT. Now, there's still a lot of housing under construction, and this is because everything's taking longer to build. But that pipeline of new construction coming in behind has really thinned out quite significantly. Again, due to those factors I talked about. You don't seek a building approval generally until you've got a level of pre-sales that allows you to commence. And then generally people will commence fairly quickly after they get that building approval. Now, the population. So over the past year, the national population has increased by about 650,000 people. That's a 2.5% increase in the population. It looks like the peak of population growth was over the year to September of last year. It has started to slow, but it's still very high on a historic basis. What's driving the population growth? The main driver is actually temporary students coming in to study in Australia, which at the moment is basically uncapped. So as long as there's demand, there's a space for those students. What this does mean, though, is it's creating a lot of pressure in the rental market, because if you're here only temporarily, at least initially, you're not going to be buying a house. You're going to be relying on the rental market. Now, if we look at the individual states, over the last year, net overseas migration into New South Wales was about 185,000, which was just slightly off its record high. Natural increase was about 32,500, which was a record low. And net interstate migration, New South Wales lost about 31,500 people to other states and territories, which is high on a historic basis. In the ACT, we had about 8,100 net overseas migrants, again, just off a record high. Natural increase was 2,800 persons, which is a record low. I should point out natural increase is births minus deaths. And net interstate migration, ACT lost about 1,800 more people than it gained from other states and territories. So what does the economy look like for this year? On the right here, you can see the Reserve Bank's detailed forecasts that they publish each quarter. But as a bit of a summary, so we've only got economic growth data up to March rather. I expect June to potentially be even weaker than what we saw in March. And then things will start to improve, mainly because the impact of higher interest rates is fading, inflation is coming down. But the other big one is that we're going to get tax cuts. And some people are saying that these stage 3 tax cuts are the equivalent of 3 interest rate cuts. Tax cuts will boost borrowing capacity, and it will likely lead to a rebound in economic activity. Although I should point out, economic activity is still expected to be well below that long-term average trend growth. Inflation is expected to moderate. Headline inflation will probably dip back into the target range this year, but underlying inflation, which is the Reserve Bank's preferred measure, is likely to stay outside of the target range. And that will mean that interest rates are likely to be on hold throughout this year. And we're looking at next year as the most likely timing for an interest rate cut. I think also the Reserve Bank will want to see how consumers respond to those tax cuts that go live in just a couple of weeks now. The labour market, we expect that there'll be further weakness in the labour market, with the unemployment rate drifting higher as those labour shortages wane and as businesses slow and reassess their hiring needs. Wage growth, as I said, is likely peaked, but we do believe that it's going to continue to grow at a faster pace than inflation, so households will continue to get real wage increases. Unfortunately, new housing construction looks likely to be even lower this year than it was last year. Dwelling investment is expected to drop dramatically this year and only rebound moderately next year. And population growth, as I said, looks like it peaked in September of last year. So it is likely to slow from those record high levels, but it's going to remain well above long-term average levels, which means we desperately need to be building more housing than we are. So let's have a look at the established housing market and what we're seeing at the moment. So in Sydney, you can see that over the last 3 months, prices have increased by 1.6%. In regional New South Wales, they're up 1.1%. The Mid-North Coast was the only region over the 3 months to May which saw prices fall. Some of the standout markets are the inner southwest. Prices are up 2.5%. Blacktown, Baulkham Hills and Hawkesbury. And then regionally, you can see Southern Highlands and Shoalhaven and Illawarra are the areas where we've seen the strongest growth over the last 3 months. If we look over the past year, Sydney prices are up 7%. Regional New South Wales prices are up 4.7%. We are seeing a deceleration of that growth in Sydney, and we're seeing an acceleration of that growth regionally. To give you some context, Melbourne prices are up about 1% over the past year. Perth prices are up about 20%. Brisbane and Adelaide prices are up about 14% over the last 12 months. Again, having a look at some of the standout areas. So in Sydney, the inner southwest, the inner west, Baulkham Hills and Hawkesbury and Parramatta have seen the strongest price growth. Regionally, Newcastle and Lake Macquarie, Richmond, Tweed, New England are the areas where we've seen the strongest price increases over the past 12 months. If we break growth out between houses and units, you can see that house and unit prices in both Sydney and in regional New South Wales, house price growth has outstripped unit price growth. Again, some of the standouts, the inner southwest house prices are up 11.1%. Parramatta house prices are up 9.2%. Newcastle and Lake Macquarie house prices are up 7.9% over the past year. Looking at Canberra, you can see that price growth has been pretty sluggish over the last couple of years. Prices in Canberra are up 1.2% over the past year, and we've seen house price growth at 1.7%, stronger than unit prices where they've fallen by 0.3% over the last 12 months. Now, if we look over the last 5 and 10 years, so in Sydney, we've seen prices rise almost 50% over the past 5 years, and they're up 87.5% over the last decade. In regional New South Wales, we've seen stronger price growth over each of those periods, 59.6% growth over the past 5 years, 107.3% growth over the past decade. And looking at some of the stronger areas over the past decade, the Southern Highlands and Shoalhaven region has seen house prices rise 142.5%. Unit prices in Richmond Tweed are up 136.5%. In Sydney, the standout market has been the Central Coast, 124% increase in house prices over that period of time. And you can see some of the laggards have actually been the inner southwest, where prices are up 88.5% over that period of time. So it's quite interesting to see how things have fared in different parts of the state over that time frame. Looking at the cost of housing versus the cost of compared to the cost of units, obviously we can see from this that people still have a strong preference for houses. The outer Western Blue Mountains and the Central Coast in Sydney have the smallest gap between house and unit prices. In terms of the largest gaps, though, you go to somewhere like Ryde, the median house price is about 230% higher than the unit price. In North Sydney and Hornsby, 220% premium for houses over units. And I guess this really speaks to the fact that we need more density in these suburbs if we want people that grew up in these areas to be able to afford to stay. Because you look at somewhere like the eastern suburbs, median house price of 3.85 million. A lot of people are not going to be able to afford that. A unit's still expensive at 1.15 million, but it's a lot more achievable for people to afford that than it is to afford the almost 4 million for a house. Which then brings us on to what's happening with housing supply. So the number of new listings in Sydney was strong over the second half of last year and has continued to see quite strong volumes this year. In May of this year, the number of new listings was up 29.3% from a year ago. And if we look at the average number of new listings in May between 2018 and 2022, the number of new listings in Sydney is up 24% compared to that same period. Every single region of New South Wales, except for New England and the Northwest, has seen more new listings this year than last year. And pretty much all of the regions are seeing a higher number of new listings compared to that 2018 to 22 average. So whether this is all of a sudden more vendors are confident because the market is proving really resilient, or whether it's more the case that people have overstretched themselves and need to sell, either way, we are seeing a lot more new stock come to the market. And we've also seen the number of total listings on the market mount. So total listings in May were up 17.5% from a year ago, and they're up 5% rather from that average between 2018 and 2022. And again, most parts of the state are seeing a year-on-year increase in total listings, and most parts of the state are now seeing a increase relative to that 5-year average. So I think the important point here is for vendors that people have a lot more choice. There's a lot more stock coming to the market. There's a lot more stock already onto the market. And it's really imperative that you set a really attractive price. We recently did some research and looking at, what percentage of sales are properties that have been on the market for less than 60 days. And about 80% of all sales are properties that are new to the market over the last 2 months. If you don't get that property sold in that first 2 months, it just sits on the market for a very long period of time. So that's really important. If we look in Canberra, a lot of new listings are up 42.5% from a year ago, and you can see they're way above that 5-year average rate in the 5-year range. And total listings are up 38.5% from where they were 12 months ago. And again, way above that 5-year average, way above the peak of the last 5 years as well. So much like Sydney, there is a lot more choice in Canberra for people looking to buy properties at the moment. Which then brings us to sales volumes. Even though there's been an increase in stock for sales, so remember, go back to Sydney, we've seen a 17.7% increase in the total number of properties for sale. We've seen a 12.5% increase relative to a year ago in the number of sales. So sales volumes are lifting, but they haven't lifted enough to offset the sharp rise we've seen in the number of properties coming to market. Again, just another reason why vendors do need to be really realistic on their prices. But across most of Sydney and across most of New South Wales, you can see sales volumes in May were higher than they were last year. If we look in Canberra, a similar story, 11.5% increase in sales relative to last year. And you can see in May, it was a higher number of sales in May than we've seen any year since 2019. So sales activity is strong, but it hasn't offset that uplift in the number of properties on the market that we have seen. Which then brings us to our measure of demand, which is inquiry per listing. So in May, in Sydney, the number of inquiries per listing was down 17% from a year ago. And in regional New South Wales, it was down 8% from a year ago. But there's definitely certain areas where we're still seeing really strong inquiry levels. You can see the eastern suburbs, you can see North Sydney and Hornsby, Sutherland, and even Blacktown, very high levels of inquiry. In regional markets, not surprising, it's the larger population areas, Illawarra, Newcastle and Lake Macquarie, where we're seeing the highest level of inquiry. But pretty much right across the board, inquiries in each of those regions of New South Wales are lower than they were 12 months ago. In Canberra, inquiry is down 21.1% from a year ago. But, if you go back to before the pandemic, we're still seeing a higher level of inquiry than we were at that time. And then if we look at how long a property is selling, so as I said, it's really imperative to get that price right or to adjust that price. A lot of properties are still selling in less than a month. The median days on site in Sydney is 29 days. It was 30 days a year ago. And if we look at that 5 years between 2018 and 2022, the median days on site was 38 days. So properties are still selling quickly, but if you don't get that property sold quickly, it becomes a much harder task to move that property. In Canberra, median days on site at the moment is 35 days. It was 36 days a year ago. And over that previous 5 years, the average was 37 days. So properties are selling reasonably quickly, but again, really important to get that pricing right or adjust that pricing. So where do we think the market's headed from here? I think firstly, if we think about recent decades, property prices in Australia have risen at a really rapid pace. And I think there's been a few big drivers of that. Interest rates. We know at the start of the 90s, interest rates were 18%. During the pandemic, they fell to basically nothing. As interest rates came down, borrowing capacities increased significantly. Now, we're not going to get interest rates falling from 18% to nothing again, so borrowing capacities are not going to get that same boost. Credit availability. It was very hard to get finance in the 80s. It became a lot easier through the 90s and 2000s, but if we look at the last 15 years, it has become more difficult to access finance. Go and try and take out a loan, the questions the bank asks you are a lot more intrusive. You know, you're going to have kids, private school fees, overseas holidays, streaming services. I don't think that's going away. And also you've got the banking regulator, APRA, coming in over the top and, you know, credit limits on interest-only lending, investor lending, changing serviceability buffers. And again, I don't think that's going away. So it is going to be harder to get credit than it was in the past. Not as hard as it was in the 80s, but certainly harder than it was through the late 90s and early 2000s. One of the other big things that have boosted borrowing capacity and household incomes is employment participation rising to record high levels. And that's mostly been driven by more women joining the workforce. And as more women have joined the workforce, household incomes have increased and people have been able to borrow more. And again, probably not going to see as many more women proportionally joining the market as what we've seen in the past. The one thing that is still strong and is starting to get a little bit more contentious is migration. And obviously having more people come to Australia drives more demand for housing. But I think if we combine all of those four, they're not going to be as strong going forward. And that doesn't mean that prices aren't going to rise, but it does mean that we have to pare back our expectations as to how quickly property prices will rise in the future. If we look right now, though, the level of demand for housing is really strong, especially when you consider how high interest rates are, the highest they've been in 12 years, and how quickly interest rates got up to that level. We have, though, seen an increase in the volume of stock for sale, but we've also at the same time seen an acceleration in price growth. And price rises this year would actually end up being stronger than what we saw last year, which was not something we were anticipating at the start of the year. The increase in supply of properties for sale, though, does mean there's more competition. I've talked about this. There's less fear of missing out. I think people figure if I don't get this property, you know, there's a lot coming to the market, so I'll probably find something in the next few months that comes that's just right. Maybe it's going to be even better. Contrast that with places like Perth, for example, where there's very little stock coming onto the market. Buyers feel like if I don't get this property, there's not going to be the right property to come on the market again, or it might take 12 months for that to happen. So given that there's more competition, people need to be very realistic on their price. We're still seeing a high cost of new housing relative to existing housing, and that's going to see people continue to preference buying existing homes over new ones. What I say to developers is the thing that you want is very little stock on the market, and you want stronger price growth in the established market so that gap narrows. And if people don't have much choice, people will start to choose something brand new. But we're not quite at that stage yet, especially with supply. We need to build more infill housing. Obviously, the New South Wales government is going hard on medium and higher density in inner city areas, and particularly around transport, which is a good thing. But there are so many political and financial hurdles. Just because you're going to allow this construction to happen, you know, most housing in Australia only gets built when you've got a level of pre-sale sufficient to go ahead with it. So, you know, making these sites financially viable, particularly in this environment, is a real challenge. And I think one of the things we will see is that the high cost of renting is likely to see more people that have the capacity to do so to become first home buyers. Now, it's probably going to cost them more, but they're going to like that certainty that, you know, there's a lot of uncertainty in the rental market at the moment, and people don't know, is my landlord going to sell? Is the new owner going to want to move in? Are they going to put up my rent 10% or is it going to be 20%? And I think people will start to pay more of a premium for that certainty that you get owning your own home, as opposed to the uncertainty of owning a rent or renting a property. So let's have a look at the rental market. So over the last 3 months, house rents in Sydney rose 3.3%, and unit rents were up 0.7%. You can see in the inner west, house rents are up 10.5% in the space of 3 months. And there's some, you know, very extreme examples of rental growth over that period of time. The cheapest rents in Sydney for houses, you're looking at the outer southwest, the outer western Blue Mountains at $620 a week, or the Central Coast $630 a week. The most expensive eastern suburbs. 1,650 is the median rent in the eastern suburbs at the moment. If we look across all of Sydney, so rents over the past year are up 9%. In regional New South Wales are up 5.9%. $730 a week is what you can typically expect to pay in Sydney, $540 a week in regional New South Wales. It's quite surprising when you look at where the strongest rental growth has been, because you would intuitively think it's going to be the inner suburbs and the eastern suburbs. Not necessarily the case. The southwest has seen a 16% rise, in rents over the past year. Blacktown has seen 12.5%. Eastern suburbs has still seen strong rental growth at 11.8%, but then Parramatta 11.7%. This is a really common trend we're seeing right across the country, that it's probably areas that are a little bit less desirable and a little bit less intuitive as to where renters would really want to be, that are seeing the strongest rental growth, seeing the strongest demand. And I think this speaks to the fact that people are tapping out on affordability and they're having to move to a less desirable location in order to get the property that they can afford to rent. If we look over the last 12 months, house rents in Sydney are up 10.7%, and they're up 3.6% regionally, whereas unit rents were up 7.7% in Sydney and they're up 5.6% in regional New South Wales. So in regional New South Wales, unit rental growth has actually been stronger than house rental growth. And you can see in Sydney, with houses rising at a faster pace, that gap between house and unit rents has started to widen up again, which probably means there's more upside in unit rents going forward. Now, if we have a look over the past 5 years, you can see that pretty much all of the rental growth over the past decade in Sydney has come in the last 5 years. Rents are up 42% in 5 years and only 49% in a decade. In regional New South Wales, a bit stronger over the first 5 years of the decade, but most of the growth again coming in the last 5 years. 42% growth in the last 5 years, 64% growth in the last decade. Richmond Tweed has been the standout. House rents there are up 90% in 10 years. In terms of Sydney, the eastern suburbs, house rents there are up 65% in the space of 10 years. If we have a look in Canberra, rental growth has really stagnated. Rents are only up 0.8% over the past year. You're looking at $605 a week to rent. That's about on par with, it's a bit less than Perth. It's about on par with Brisbane. For a long time there, Sydney and Canberra were overwhelmingly the most expensive markets to rent in. It's not the case in Canberra anymore. We've seen rents flatlining for the last couple of years. House rents, $699 a week, up 2.8% over the past year. And unit rents are up at $570 a week. So rental yields have pushed higher over the last couple of years, but with rental growth slowing relative to price growth, we're starting to see rental returns roll over. And, New South Wales still has comparatively very low rental returns across the market. In Canberra, yields are still trending a little bit higher. House yields are quite low, but unit rental yields at 5.3%, again, reasonably attractive for an investor. Looking at rental supply, it's still a really challenging market. So the number of new rental listings in Sydney was down 1.8% from a year ago and 11% lower than the average between 2018 and 2022. There's a few exceptions. You can see that there's more new listings in the inner west, in Parramatta, in Baulkham Hills and Hawkesbury, but a lot of areas are seeing fewer new listings, and total rental listings are extremely low. They're 5.1% lower than they were a year ago, and they're 30% below the average between 2018 and 2022. So it's a really tough rental market out there in Sydney, and it's a similar story in regional New South Wales as well. If we look in Canberra, there is quite a bit more rental stock in Canberra than we're finding elsewhere. So yes, new rental listings are down 5.5% from a year ago, and total rental listings are down 10.7%. But they're well above that 5-year average level. So there is quite a lot of rental stock available in Canberra, especially compared to the major capital cities where things are extremely tight. Looking at our inquiry per listing, so the number of inquiries per listing in Sydney is down marginally from a year ago. In regional New South Wales, it's up more than 25%. The big increases in Newcastle and Lake Macquarie, Richmond Tweed, Illawarra. The areas where we've seen the biggest increase in Sydney over the past year in inquiries per listing is out of southwest Sydney, Central Coast. The highest volume of inquiries per listing is also out of southwest, outer western Blue Mountains, southwest Sydney. So again, speaking to the fact that some of those areas that you wouldn't intuitively think a lot of people are looking to rent in is where we're seeing that highest level of inquiry, which speaks to the fact that people are having to sacrifice on location in order to get a rental. If we look in Canberra, inquiries per listing are up 22.2% from where they were a year ago. So even though there's more stock, there's starting to be more people looking for those rental properties as well. Turning to vacancy rates, rental vacancy rates are extremely low. Have a look in Sydney. Before the pandemic, we had a vacancy rate of about 3% and rents weren't increasing. So that basically tells you where rental vacancy needs to get back to in order to stabilise rents. And obviously we're a very long way from there. Seasonally, things do lift a little bit at this time of year, but we've still got a very low rental vacancy rate. You can see in places like the Sutherland Shire, vacancy rate of 0.9%, 1.1% in inner southwest, which basically means there's nothing available. Comparatively, Canberra does have higher rental vacancy rates, but it's marginally lower than it was 12 months ago. But we're looking at much higher rates than we were seeing before the pandemic, and that explains why rental growth is really flatlined. And if we look at days on site, so the median days on site in Sydney for a rental property is 19 days. It was 20 days a year ago. On average, between 2018 and 2022, in May, you were looking at 28 days. So again, this just highlights how quickly things are leasing in Sydney. In Canberra, a bit of a different story. We have seen days on site fall relative to a year ago, but the median days on site is much higher than it was on average between 2018 and 2022, which again just speaks to the fact that there's more choice in a market like Canberra. So where do we think the rental market's going? Rental prices have been climbing, and there's a few factors. During the pandemic, we saw average household sizes reduce quite a lot. Now, household sizes started to increase again, but it's actually started to taper off that growth, and it's below the level it was at before the pandemic. So if you've got a smaller household size, you need more households, and that's driven a lot of demand for rentals. At the same time, we've got low levels of new housing construction, and there's a number of reasons for that. But if you think about what's being built, so we're getting fewer properties being built, but a lot of the new properties, particularly inner city apartments, they're being targeted at owner occupiers. If you go back 10 years to when there was a huge amount of apartment construction going on, a lot of that was built, 1 bedroom, 2 bedroom apartments sold to investors. So when that got completed, you were adding to the rental stock, and we're not getting those rental stock additions anymore like we were. So the shortages of rental accommodation are persisting. And at the same time, we've got rapid population growth, mostly from migration and mostly people looking to rent somewhere. So it's a pretty dire situation. We have seen rents rise rapidly, but we are seeing the annual rate of rental growth slow. And I think what's happening is the capacity to pay the rents that landlords are seeking is becoming an issue. So we still think rents are going to climb, but we think that rate of rental growth is going to slow from where we've seen over the last couple of years. As rental costs get more expensive, what are people doing? As we talked about, they're moving to less ideal locations. They're moving into smaller properties. So if you're in a house, you move to a smaller house, or you move to a house further away. If you're in a unit, you move to a smaller unit, move to a unit further away. Or what we're seeing a lot of at the moment is people going back into share housing. And that's probably not through desire, that's out of necessity because they simply can't afford the rent by themselves. So how do we address what's happening in the rental market? If we look at the supply side, we need to build more housing. I think that everyone understands that. But even if we fix today everything that was stopping from more supply from being built, it would take 3 years for that supply to show up. So the thing you can mostly do is encourage more people to invest in residential property to increase the supply of rental stock. The other side of things is demand. Obviously, we can try and lower rates of migration, which the federal government is trying to do, but it's really difficult to implement. You can increase Commonwealth rental assistance, which the government has done over each of the past 2 years after no one touched it for about 20 years. So there's probably more to do there. The other thing is helping or encouraging more people to become first home buyers. Not always, but generally, if you're a first home buyer, you're exiting a rental property and making that available for someone else. And I think we are expecting rents to continue to rise, and that will see more investors coming into the market. It also will probably encourage, as I mentioned earlier, more renters to exit the market and purchase, just for that certainty that they get with owning their own home that they simply don't have in the rental market. And that's the end of my slides. Thanks very much for coming today. We do have some question time, which we're going to do now, and we've got a poll that's going to pop up just about this webinar, if you could answer that as well. But I'll go to the questions after I stop sharing my screen. So the first question comes from James Kirkland, and it says, Cameron, after the session, are you able to share that 80% of all listings are new listings? Just on that, it wasn't of listings, it was around 80% of the properties that sold were properties that had been on the market, but that had come to the market over the last 2 months. We actually wrote something about this recently. So if you go to just Google PropTrack Insights, there's an article there from Karen Dello from a couple of weeks ago, which talked about that. On the chat, have we got any questions there? So Aja said, so surprising that listings are up. That's not what it feels like in the market. I do think what we're seeing is a lot of properties are sitting on the market that are there from unmotivated sellers. Basically, people are being stubborn and saying, if I get my price, I'm going to sell. If I don't get my price, I'm not budging from that price. But there is quite a lot of stock on the market at the moment. I guess I'm not sure where you are located, but might be a little bit different in your patch. But certainly broadly across Sydney, there is quite a lot of stock. Now, it hasn't increased to the same magnitude as, say, stocks increased in Melbourne, but it's certainly lifted quite a lot over the last probably 12 to 18 months. Q&A. Are you able to make slide packs available? So this has been recorded and this will be sent to you, anyone that has attended today. Alex, do you know if the government has any plans to build more units and houses? And if yes, how many in what period of time? So the federal government has a stated goal to build 1.2 million well-located homes over the next 5 years. And there's a plan, particularly in New South Wales, around where that's going to be delivered. They're putting a lot of weight into infill housing, and changing planning schemes, improving the planning process, which in my mind is a lot easier said than done. The cost of new housing in Sydney is, I don't live in Sydney, I think it's eye-wateringly high. I mean, you go out to some of these new housing estates, which are 60 k's from Sydney, and house and land costs $1.2 million. So the cost of building and the end cost of new housing, to me, is a real problem. And you can do all this work to try and deliver more housing, but there's a finite number of buyers at the prices that this new housing is at. Next question. Will the government look to put rent increase gap in, I'm assuming that's meant to be cap, in New South Wales? I don't think the current state government will, but I think the Greens are going to continue to push for rental caps right across the country. I think it's pretty unlikely it gets up. All right. Thank you very much for your time. I hope that was useful for you, and good luck with the next 6 months in the market, and hope everything goes well for you. Thank you very much.